Good evening, everybody. I'm Raymond Dahlman, president of DSA Financial Group. This is the weekly wrap-up for December 17th, 2021. Hope everybody's had a fantastic week out there. If you're not watching my weekly or my daily videos, the Liberty Call, I would highly suggest that you subscribe and or like, depending upon what service you're watching on, whether or not it's Facebook or YouTube, because you don't get an email for those. I just do those around 2:20 every day Mountain Time. So I would suggest if you want to know what the daily news is there, subscribe and check in on that. Definitely an interesting week. The markets were a bit back and forth with, what some perceive as good news with what the Fed is doing. For those who haven't been paying attention, the Fed has decided to speed up the tapering that they were going to do, meaning that they're going to reduce their bond purchases. They're going to cut that time in half. Originally, they were going to reduce it each month by, I believe it was $15 billion. And so that they would have eventually hit the zero mark by next summer. Now they're speeding that up and hope to have it done by March. So we'll see what happens. So, and then also they're planning on three interest rate increases in 2022. So I don't know if that's necessarily going to solve a lot of our problems, but we'll see. So, all right, well, let's go ahead and jump into how the markets did this week. The Dow Jones, let's start up here. It was a red line or a red candlestick. The Dow Jones was down 1.64 for the week. The S&P 500 was down about 1.72. NASDAQ, let's see. NASDAQ was down 3.19. Dow Utilities, definitely the bright spot this week. It looks like up 1.12. And the Dow Transports were down a whopping 3.44. So looking across or looking at, the week domestically, it looks like everything was down except for utilities. So, and with it being winter, that doesn't really surprise me. All right, well, let's go ahead and take a peek at what is going on in the world. All right. So initial jobless claims came in this week at 206,000. The forecast was 200,000, so just 6,000 over forecast. So not too terrible. And the continuing jobless claims came in this week at 1.845 million. The forecast was 1.936. Last week's numbers were revised up from 1,992 up to 1,999. So about 99,000 over forecast. That isn't that spectacular, but this week's numbers looked pretty good. So we'll take the wins where we can get them. All right, some of the numbers that came out this week were the retail sales year over year. They came in at 18.21. The previous was 16.26. So looking at those sales numbers, they do look, again, fairly strong over the last few months. Definitely much better than where we were a year ago. And, definitely much better than, when the whole COOF BS started. So it's a shame we've destroyed our economy over a cold, but you have to save a few fat people and elderly people from catching the sniffles. So, all right, U.S. housing starts came in at 1.679 million. The forecast was 1.568 million, so came in above forecast. That's certainly a good thing. And looking back on the historical trend line, things do look fairly strong for other than that little blip we had last year. Housing starts still look strong. And then the last metric that came out this week was industrial production year over year. We're sitting at a 5.27. Last month's number was 5.29. So again, it seems to be holding fairly steady right here, again, after the collapse of last year. So we will see what goes on there. So, all right, well, let me pause that. I did want to go over the interest rates. I talked about that the other day when I was Let's see. Interest rates. I probably should have had this up before we got started here. So, all right, the Fed funds rate. So what I was interested in was that, the Fed is talking about, increasing interest rates over the next year. I'm not sure why the Fed numbers are taking so long to look at. All right, let's go ahead and add that back in. All right, and the reason I bring this up is, some of the people I listen to are not real pleased with the talk of, well, we're just going to raise interest rates up to, maybe 2%, when inflation is at, I don't know, 6, 8, 10. I mean, what is the real number? I mean, those who calculate the numbers have stripped out so many things that, what we used to consider, items that were inflationary back, 20, 30 years ago. So it's not quite the same. So, but what I was curious about, and I didn't want to speak to this without having the exact numbers, was, what were interest rates, around 1980 when Paul Volcker, who was the Fed chair at the time, put the kibosh on the inflation that we had, and how he did it was right here. You can see interest rates in December of 78 were 10%. And let's see what they were in February of 74. That's when I was born. February of 74, the Fed funds rate was 8.97%. Then for the next couple of years, it looks like it dropped into around the 5% mark. So in this time, we are experiencing heavy inflation through the mid and late 70s. And you can see how high they had to jack up interest rates, up to, what was the highest number here? Let's see, 19% in January of 1981. And then what was this other high number? 19.1% in June of 1981. So, I know the Fed is claiming that they're coming out and trying to do something to mitigate all the inflation that, the Americans are experiencing. But to me, what this looks like is a thimbleful of water on an inferno. So you're not really going to put out the fire with a little, it's like trying to take a piss on a giant flame. You're not going to do anything to it. So you might burn your pecker off. So, I don't think raising rates up to 2 or 3, maybe even 4% is really going to, do much. So, I mean, if the Fed was serious and seriously, they can't act surprised about everything that's gone on over the last, 2 to 3 years, or really the last 20 years, the artificially, keeping our interest rates artificially low for the better part of 2 decades. You've built up a lot of malinvestment in the credit space. And that, personally, I think that's all going to come crashing down, with the dollar. So I could be completely wrong. This is just my own personal opinion. So, but I did want to, like I said, give people a point of reference. This is where we probably got to get to, somewhere between 15 and 20% interest rates to put a halt to this massive inflation that we're seeing. So, you can continue to, throw, Dixie cups of water at the fire, but I don't think it's going to do very much. So, all right. Well, that's everything I had for today. Sorry, no articles to read through. My errands or things that I had to take care of this afternoon ran a little long. So I'm going to wrap this up in under 10 minutes. I'm sure most of y'all, well, the few people who actually, click on this and then watch it to the very end, I thank you. You're the best people in the world. The rest of y'all who don't watch it, I'm sorry, you can't complain if shit goes bad. So, all right. Well, everyone have a fantastic weekend. I'll be back on Monday with the weekly economic update. If anyone needs anything from me during that time, feel free to, drop me a phone call or an email. Smoke signals always work. And you have a good weekend. Bye.